This Father's Day, being this Sunday, we wanted to bring you a father-son dynamo in honor of the occasion. And who better than Miller Value Partners, Bill Miller III and Bill Miller IV, which I have to always remember, it's not senior and junior, so who, the original, I mean, we're going way back.
Well, the more interesting question is when his younger brother was born, I wanted to make him the fifth, but my wife wouldn't let me do that.
That would be
I want the George
weird.
Foreman kind of thing, you know?
Yeah, well, that's true. Maybe it works for George. Anyway, guys, welcome, and we love talking to you again. And there's a long list of stocks to discuss, so let me just plunge right into it. So, Bill, let's start with Amazon, just because that's been such a winner for you over time. Every other segment we're talking about, how big can these companies get? Are they going to hit $1 trillion? Should they buy media assets? And what would you like to see? Would it be bad for you if Amazon started to buy a lot more media assets?
I don't think Amazon's going to buy anything in the sense of media space, because they already got their own production studio. And one of the things that they saw early on that Netflix saw was that the media business was fragmented between content and distribution. And with the internet, you can put those two things together, so you can greenlight a project, make it, and distribute it globally, which, again, can't be done in traditional media. That's why AT&T bought Time Warner.
Right, and ironically, now the kind of the regulatory environment is okay with that tie-up because Netflix and others have been, so they've done it already. If you said no to this, you'd probably have to go back and say, well, somehow they don't work either.
Yeah.
So you think Amazon can build this itself in-house?
Oh yeah, they're already doing it. I mean, that's part of the reason that they just raised Prime by $20. It's because so many of the people are signing on to Prime Video, and the way Jeff thinks about Prime is, let's give people a lot more benefits, and then after we give them that, a few years later, we'll raise the price.
And do they have to make it as successful as Netflix and maybe this new Disney or whatever, you know, what a combined Comcast-Fox looks like?
They're basically following the Netflix model in that they're going to be making more and more original programming, movies and shows each year. Part of the idea here is that what Jeff wants this to become is to get so much content that part of the business effectively is fixed costs, so that then the next project or something that comes along is all pure profit.
So is Netflix a bad investment right now then, with all of these other players aggressively coming on the scene?
You know, we bought Netflix on the old stock at 8, sold it in the 30s, then it went to 300. Then it went back to 55, we bought it there, and we made 12 times our money in, I think, 18 months. And sold it and shouldn't have done that because it's doubled this year.
Right, right.
But it's very expensive. It's very good, but it's very expensive.
And so they're just going to have to contend with, you know, the fact that other people are coming and willing to spend maybe, I don't know if it's going to be $8 billion a year, but it's going to be billions, these new competitors. What about Apple today? They're tying up with Oprah now. So they did a cartoon deal yesterday. They've got Oprah today. Should they just step in and buy somebody like Disney and just say, you know what, because it doesn't sound like they're able to build, you know, to scale the way that Amazon is in-house.
That wouldn't be a bad deal, in my opinion. I always thought that, you know, Warren Buffett says he can't find something to buy, and I think Disney, if he'd lever up a little bit, would be a great thing for him to buy, because he could then spin off those theme parks into an MLP, the way MGM did with MGM Properties, and recoup a large portion of the price.
Have you mentioned that to Mr. Buffett?
No.
Because you think that it would be a good fit for Berkshire to have Disney?
It would be a diversifier for sure, yeah, and it could be built on that.
Is that an option for Disney if they don't win Fox assets?
I don't know. I mean, Disney doesn't want to sell, I'm sure, but it's around 14 times earnings, so it's not very expensive.
All right, Quattro, well, last time we talked to you, you had a couple of names like RH that were out of favor but have done pretty well. What's in the portfolio now?
Actually, one of the names I run an income fund with them. So one of the names kicking off a high level of income we like right now is Tupperware, actually. A name a lot of your viewers may be very familiar with. It trades with a 6% dividend yield right now, believe it or not, which sounds high, but is actually incredibly sustainable if you look at the cash flows they're kicking off.
Is this a demographic play? Is this a millennials now finally? Because Tupperware sounds to me like an old story, a mature, you know, but is it,
right.
Maybe that's the attract?
Well, you think about it, it should be theoretically a very stable, steady grower over time, grow roughly a global GDP. But right now the stock is actually trading at a 6-year low. People have sold the stock because of trade war fears.
They've sold Tupperware over trade wars?
Yeah, potentially. Also, weak emerging markets, strong dollar, bad for Tupperware. So if you just look at the valuation, very high dividend yield, very sustainable, very attractive business, high returns on equity over time. So we like that a lot.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.